Hello, Dividend Conquerors. Welcome back to Dividend and Conquer, your trusted guide in the maze of stock market investments. Today we're donning our financial explorer hats, and yes, they're fabulous, as we set sail on a captivating journey through the high seas of real estate investment trusts. Picture us navigating through the waves of the stock market with a compass that's more reliable than my weather app on a rainy day. We're heading straight for a showdown between two heavyweights: Realty Corporation and Realty Income. Since 2021, their approach to monthly dividends has been stirring up more excitement than a surprise tax refund. It's time to answer the million-dollar question. Which of these financial Goliaths is the better investment for your portfolio? Are we looking at a David and Goliath story, or is it more of a Hulk versus Thor scenario? Let's dive in with a dash of humor in our pockets and a keen eye for detail to unpack this mystery and discover the hidden gems in each. Realty Corporation first. Imagine a colossus striding through the retail landscape, reshaping it with every step. Since its inception in 1971 and its metamorphosis into a REIT in 1994, Realty has emerged as a luminary in the sector, with a diverse portfolio of omni-channel retail tenants. Contrast that with Realty Income. A titan in its own right for over 50 years, it has been the beacon for investors in pursuit of consistent monthly income. Their strategy is a masterclass in precision acquiring standalone commercial properties leased to elite tenants. Their real estate empire stretches from the United States to the charming streets of Europe. Property portfolios. When it comes to portfolio size, it's a classic David versus Goliath scenario. Realty Income's global reach encompasses over 13,000 properties, a testament to its vastness. Take, for example, their expansive holdings in the retail pharmacy sector, with prominent tenants like Walgreens and CVS. This sector is known for its resilience, even in economic downturns, as people continue to prioritize healthcare expenditures. Realty Income's diversified approach is further exemplified by its investments in international markets such as the UK and Spain, adding layers of geographic and economic diversity to its portfolio. Realty, though smaller in scale, shines with a near-perfect occupancy rate of 99.7%. This impressive figure is not just a number, but a reflection of their strategic selection of tenants and properties. For instance, Realty has a strong presence in the convenience store market with tenants like 7-Eleven. These stores often thrive due to their essential nature, offering goods that are in constant demand, regardless of economic conditions. Moreover, Realty's focus on properties leased to companies like Walmart highlights their strategy of aligning with businesses that are not only recession-resistant, but also e-commerce adaptive. Walmart's robust online presence, combined with its physical stores, creates a hybrid model that caters to a wide range of consumer needs and shopping preferences. Both entities share a roster of similar tenants, signaling their acumen in choosing businesses that can weather economic storms and the shifting sands of e-commerce. This common ground is evident in their investments in dollar stores, such as Dollar General and Family Dollar. These stores often see an uptick in business during economic slowdowns, as consumers seek more budget-friendly shopping options. Additionally, the presence of restaurants and gyms in their portfolios indicates a balanced approach, blending necessity-based retail with lifestyle and discretionary spending establishments. While these sectors might be more sensitive to economic fluctuations, they add variety to the portfolio and have potential for high returns during periods of economic stability and growth. In summary, the contrasting but complementary strategies of Realty Income and Realty in their property portfolios paint a picture of two giants adept at navigating the complex terrain of real estate investments. Realty Income's approach is characterized by its vast scale and international diversification, while Realty's strategy hinges on high occupancy rates and a focus on e-commerce resistant and essential service providers. Loving this deep dive into the world of dividends and real estate? Then why not subscribe? Join our fast-growing community of smart investors and never miss out on our insightful content. Now, onto the performance arena. Imagine it as a stock market version of a talent show, where the judges are the investors and the performers are our two real estate giants. Realty has been strutting its stuff like a financial peacock, boasting a 12.69% average annual return over the past decade. That's the kind of performance that makes investors sit up in their armchairs and spill their coffee in excitement. This impressive figure didn't just appear out of thin air. It's a testament to Agree Realty's savvy in picking prime properties and locking in profitable leases. In contrast, Realty Income, with its respectable but lower 8.94% return, has been more like the reliable performer that always hits the right notes, but doesn't quite get the audience on their feet. It's like comparing a solid pop song to a chart-topping hit. Both are good, but one clearly has an edge. Agree Realty's dividend growth story adds to their allure, much like a singer who can dance too. It's not just about the dividends they pay now, but how those dividends have grown over time, making it a potentially more attractive option for those investors looking for growth and pizzazz in their portfolio. Recent strategies and future prospects. But the plot thickens, almost like a financial soap opera, when we examine their recent maneuvers. Realty Income's approach in the face of soaring interest rates has been nothing short of a high-wire act. Their bold acquisitions speak of a vision as daring as wearing socks with sandals. Unconventional, yet strangely compelling. However, their method of funding these expansions, issuing new shares, has raised eyebrows and concerns over dilution. It's like inviting more people to a pizza party, but not ordering more pizza. Everyone gets a smaller slice. In contrast, Agree Realty's strategy is like the friend who knows exactly how to invest in a good pizza party. They've adopted a more measured growth strategy, possibly appealing to the investor who prefers a stable and predictable feast over a risky banquet. Their approach seems to say, let's grow, but let's not go crazy with the pizza orders. Stability versus expansion. Delving deeper into the stability versus expansion debate is like peering into a crystal ball, trying to decipher the future of these REIT titans. Realty Income's strategy is akin to a globe-trotting adventurer, their global footprint and sheer size offering a level of diversification as varied as a world tour. This extensive reach offers investors a piece of real estate from every corner of the globe, from the bustling streets of the United States to the historic alleys of Europe. On the flip side, Agree Realty's approach is more like the wise local guide who knows every nook and cranny of their city. Their focus on steady, sustainable growth within a more confined geographical area might not have the glitz of a world tour, but it offers a sense of reliability and familiarity. This strategy might strike a chord with investors who value financial stability and consistent performance over the thrill of aggressive expansion and global conquest. In conclusion, both Agree Realty and Realty Income present compelling, albeit distinct, narratives in the world of REIT investments. It's a bit like choosing between an action-packed blockbuster and a critically acclaimed indie film. Both have their merits, and the best choice depends on the viewer's, or in this case, the investor's, taste. As we near the end of our exploration, a question for you, our savvy viewers. Between Agree Realty and Realty Income, which one do you believe is the superior investment for 2023, and why? Share your insights and predictions in the comments below. Remember, we are not financial advisors, and the content presented in this video is for informational and educational purposes only. Always consult with a licensed financial professional before making any investment decisions. That's all for today's in-depth look at these dividend juggernauts. If our analysis has given you new investment insights, please show your support with a like. Don't forget to hit that subscribe button for more content on high-yield investment strategies. Until our next financial adventure, Dividend Conquerors, stay informed and keep conquering the investment world.